Hello, everybody, and welcome to our virtual tax school webinar series. My name is Amar Medic, and I am the product marketing manager for TaxWise. Today, we'll be covering a variety of income splitting strategies that can help your clients or even your own tax business save money. Keep in mind that we try to host one webinar per month, so please be sure to join us in the future as if you find today's sessions to be informative. During the webinar, you'll be able to submit questions to the team and get those answered live. With that said, I'm very pleased to introduce our speaker for today, Mr. Ryan Hubbs. He is an accounting expert and solutions architect here at Wolters Kluwer. He has years of experience working in the tax industry, and he will be sharing his insights on how you can utilize income splitting strategies for you and your clients. So without further ado, let's get started. Ryan, please take it away.
Thank you. Thank you for the kind introduction. And yes, today we are going to be going over income splitting. And specifically what this is, and we're going to go into this in great detail today, from what it is, how it's going to work, how it's going to save you money, how it's going to hopefully save your clients money. I think it should save your clients money, all the way to actually going into the tax software and looking at basically how we're going to input this data into tax software as well. So this should be a very comprehensive subject. This is a little bit more advanced than what we normally do. I've tried my best to really break this down and make this as easily digestible as possible. But if you can take away some good nuggets from this, I think this is going to be a very good tool to not only save your clients money, but then also on your end, offer this as a financial service to potential clients that this would benefit, and then charge them for that service, where you're going to have some income also coming in during some of those slower months of the year that aren't necessarily tax season months. Just to give a brief background on myself, my name is Ryan Hubbs. I have my background in accounting. It's what I went to college for. And I worked for 2 CPA firms after I graduated up in the DC area, and did a little bit of everything. Did nonprofit work, government compliance work, even did a few audits, but most of what I was doing was taxes. So I can definitely relate to the grind of trying to get through so much work in such a condensed amount of time. We have a very limited amount of time in this field to really make our year's worth of income, right? And so it's really my goal for each one of these presentations to either find ways to get through tax returns more efficiently and accurately, or with a topic like this, try to show you there can be different revenue streams for some of those slower months of the year. My current capacity here at Wolters Kluwer, I'm a solution architect. Solution architect is a really fancy way of saying I'm a product specialist. I know all of our tax softwares like the back of my hand, and it's really my job to go in and show you the benefits of using these different softwares. And today, as part of like a piggybacking on that, I do host these tax schools to try to impart some knowledge to other people within the industry. Now, specifically today's objectives, we're really going to be the best way to think of how we're going to go about this is building a pyramid. We're going to start with the base and just go over what exactly is income splitting. If you actually go and Google income splitting, a few different things will pop up that aren't necessarily the same items. So we're going to be going over specifically the type of income splitting we'll be talking about today. Once we go through what it is, we're going to talk about what the benefits are, why you're going to want to learn about this, why you're going to want to incorporate this into your firm. We will definitely talk about some of the limitations imposed by the IRS on income splitting. They have clamped down a little bit, not too much, but just a little bit on how much of this you can do, as the IRS is losing a ton of money on it just because the tax benefits are basically, I don't want to use the word guaranteed, but if you do this properly, you will show tax benefits as compared to having like a sole proprietorship, for example. We're going to talk about how to use income splitting as a financial planning service for your customers, specifically how to identify which customers will benefit the most from this, and then also conversely targeting those customers that are most likely to pay you for this service, pay you to split their income for you and get them set up as an income splittable entity, I think is the best way to put it. And then, at the very end of this presentation, we are going to go into tax software and just talk about really the differences, what you're going to be doing. This is going to be very similar. It's not going to create additional work for you, but where you're inputting data is definitely going to change on the various forms within a tax prep software. So do want to spend a little bit of time going through this and just showing you the differences so you feel comfortable. Now, with our first objective today, we want to talk about what income splitting is. And this is going to be a tax reduction strategy. And this is a strategy that the IRS has imposed. This is something that they know about. This is something that people have been taking advantage of for a very, very long time. This is not anything that's new. What I will say is I don't think the knowledge is quite out there where everybody knows that this is a beneficial tax strategy to you. And if you have a side business and you're an expert, let's say your side business is you're a plumber. If you are an expert in plumbing, knowing the ins and the outs of the tax code and what's the best entity to get set up as, what's going to give me the best taxable advantages, that's not really going to be your specialty, right? That's really going to be our specialty as tax preparers, as accountants, CPAs. I know we usually have a few lawyers on here as well. That's really going to be our specialty to offer as a service to our clients. Now, the gist of what income splitting is that this can either be implemented if you own a business and if it has S Corp status. It's very important to know that it has to be an S corporation. And how this is specifically going to be a tax reduction strategy, it's going to greatly reduce the amount of self-employment taxes due. And I hosted one of these presentations a couple months ago where we went over the self-employment tax in pretty great detail. But basically, if you didn't see that, what you need to know is if you own, well, I guess I'll backtrack. There are two halves to the employment taxes. Let's say I'm a W-2 worker. My company would typically pay half of my employment taxes, and I would pay the other half. That total amount equals just over 15%, but it's split between me and the company that I work for, right? Well, if I own a business, how the IRS is really going to view that with your employment taxes is that you are not only the employee of your own company, you're also the employer of your own company. And you're having to pay the self-employment taxes twice as compared to a W-2 worker, because you have to pay it on the business that you own. You are then treated as an employee, even though you own the business, and you have to pay those taxes again, meaning that full 15.2% of the employment taxes you are paying on top of all the additional other taxes that you have to pay. The benefit of income splitting is going to be you're only going to have to pay roughly half of those employment taxes, because how you're going to get income is going to be a bit different. You're not going to take the majority of your income through wages. You're going to be taking the majority of your income through like a dividend distribution from your company. And that's why you have to have an S Corp status. The reason that you have to have an S Corp status is you need the stock to pay yourself, basically. You need to take what's the word I'm looking for here? You need to take the money that the company is making, and instead of paying yourself a wage or only a wage, you need to take distributions out of your company, which is going to change how it is taxed completely. It's going to be taxed at completely different tax rates with completely different rules. And this is going to be the gist of what income splitting is. We're trying to move wages income as much as possible into distribution income to avoid as much of the self-employment tax as possible. And the couple common questions I get are S corporations the only entity that can take advantage of this strategy? And the answer to that is going to be almost certainly in all situations. Yes, there may be a few handful of situations where another entity may work, but for the purposes of this presentation, we're going to be focusing on the S Corp, as this is going to be by far the easiest way for not only you to get their tax returns done and to use this as a financial service, but also for you to make money off of getting them set up as an S corporation. Another common question is, how much money can income splitting save my clients? And it's going to be variable. And I think the easiest way to think of this is the more money that they make, the more money they are going to save. And when you're really looking at who you want to target as clients to offer this financial service, looking at their AGI is probably going to be the best place to start off. So with all that being said, I just want to make sure that we're getting this first point across. I do have a polling question here. And what this polling question is if a sole proprietor and an S Corp both have $75,000 in income, who will pay more taxes? Not who is going to save more on taxes, but who is just going to pay more on their taxes. And I just want to open this up, make sure I've got my first point across. If we have, then we'll go ahead, we'll move on to the next slide, and we'll really drill down into the numbers so we can specifically see why which one of these entities is going to be better as far as taxable savings. So I'll give you all just a little bit of time, and then we'll go ahead, we'll read the polling results, and then from there we'll go really dive down specifically into the numbers. Okay, and we'll give you all just a little bit more time, try to get as many people to answer as possible. Don't feel bad if you're not quite sure. We still have a lot of presentation to go over. Just say you're not sure. I might reiterate a couple points. Really just want to use this to help you all become as knowledgeable as possible. So don't feel like this is a test. This is just letting me know if I need to reiterate anything that I've already gone over.
I think we're good. We've got most people voting.
Okay, and what are the results?
So most people say sole proprietor.
Most people say sole proprietor will pay more taxes, and that is going to be correct. Great. So let's actually go ahead and drill down into the numbers here. And what I did is I actually used the tax preparation software to go ahead and prepare both of these figures for us. And you can see on the left side, I have if this entity made $75,000 and was taxed as an S corp, and then on the right side, I have they made $75,000 and taxed as a sole proprietor. Now, one thing about being an S corp is you do have to have part of your income be wages. It can't be zero. We are going to go over specifically the guidelines to this in greater detail, so don't get hung up on the number so much. I just picked half just to give it, a pretty broad example, right? Half their income's wages, half their income's going to be distributions. And as you can see, yes, the business taxable income is much lower for the S corp than the sole proprietorship. But then we have to go and look at the deductions to AGI. We can go ahead and remove those self-employment taxes from both sides, and you can see there's the double taxation on the sole proprietor. And once we add in the wages, well, when you get to the AGI, look, it actually looks like the sole proprietor is going to be the lower cost option as compared to an S corp. But you have to continue this and take this the full way through the cycle. Once we go through the next step, we're going to take our standard deduction. I just put $12,000 here. We can see the taxable income is still a bit higher. We can see the federal taxes. So far, it's looking like the S corp is going to be more in taxes, but we have to add in those self-employment taxes, right? And once we actually go and add in the self-employment taxes at the different rates, you can see, look, they're having to pay more as the sole proprietor, and they pay half as the, the S corp. And the total taxes here, we can see just under $15,000 for the S corp, just under $20,000 for the sole proprietor. This is a very rough example. If you went and did this, and changed some of these figures, it could change a bit. But when you really look at that breakdown, it's about a third more in taxes, a little bit more than a third more in taxes for the sole proprietor. And, I have a couple clients, right, that if I told them I could save $5,000, it might not be a huge deal to them, but most of my clients will be very, very, very happy to go ahead and save additional $5,000 on their tax return. And this is one of the tools that we're going to use once we get a little bit more into this, where you can become more than just a tax preparer to your clients. If this is something that you're offering, you're saying, look, not only can I save you $5,000 this year, I can get you tax savings around this amount in perpetuity for the rest of that business's life. This is going to be yearly savings. This is year one, but as you continue to go year after year after year, you're going to see these taxable benefits. If they did increase their income, the taxable benefits are probably going to grow as well too. It's only going to get bigger. And let's go next and talk about specifically the wages section, as this is going to have some limitations to it. This is really the hardest part to get right, but there are some specific guidelines from the IRS, and there's also a golden rule that I'm going to tell you, where if you're ever confused, just follow the golden rule and you should be fine. So let's go ahead and move to our next slide, and let's talk about some of these income splitting limitations. And the first one's going to be after the first $100,000, the self-employment taxes do go down. They get reduced. So you are going to see diminished savings as compared to the first $100,000, but they're still going to save money. It's not like they're going to start paying more once you cross that threshold. It's just you're going to see the benefits become less once you cross the first $100,000. But we also have to keep in mind here the income will still be taxed by the IRS. Splitting the income is only removing half of that self-employment tax and moving it to different subjects. You know, things like their AGI are still going to come into effect as far as tax brackets and things like that. So we're not completely making the income not taxable. We're just making it less taxable. And that's a very clear distinction that you need to know when discussing this strategy with potential clients of yours. And lastly, let's actually talk about the wages that have to be some of the wages. Let me go ahead and backtrack. So some of the wages are going to have to be taken out, whether it's an S Corp, whether it's a sole proprietor. And if we go back to this example, you can see I just picked half. But I just did this to show a picture here of what it could save them. There are going to be specific guidelines on what they need to take out as wages. And the amount they take out as wages, what you need to know is the more wages they have to take out, the less tax savings they're going to have. So the IRS has implemented a reasonable test, that it has to be reasonable. It's going to have very clear guidelines that I think once we go over these, it's going to seem pretty straightforward to you all. And specifically, there was a court case that happened. It was Watson versus the commissioner. And this was the court case that set up these reasonableness requirements for the income splitting. And specifically what happened is there was a CPA who was using income splitting to really minimize the amount of taxes that were due. And what he was doing is he was making over $200,000. And he had to pay himself some salary. He did know that, but he paid himself only $24,000 in salary while shifting the other $192,000. Excuse me, tongue twister. The other $192,000 to net income. And the IRS actually sued him and said, "This is completely unreasonable. This is an unreasonable amount. You can't hire a staff accountant for $24,000. You're a business owner. How are you going to go ahead and say that you're only worth $24,000? But the law at this point wasn't clear. This is what the court case was for. And what ended up happening is the IRS won the case. The judge sided with the IRS. They said this is too low an amount and that he needed to pay himself more. But the nice thing about this court case is that they still give a lot of leeway in determining the reasonable income. But what it also did was it established a few different guidelines that must be followed. And specifically what these guidelines are going to be is I have a slide here with the different items. Income splitting reasonableness guidelines. Well, the first rule is professional services should take more income than non-professional services. So if you have someone like a lawyer, a physician, a dentist, the IRS is actually going to scrutinize these much more than a non-professional service. As with professional services, the easiest way to think about this is if they're offering their knowledge really as the income driving force, they should be taking more money. It's not going to be as dependent on what their inventory is. It's not going to be as dependent on what their the seasonal fluctuations of inflation and things like this. They're really selling their professional services as a service being the key word. And like so, they should probably take more money out as they typically are higher income earners. Second guideline that they set up is the full-time working business owner should take more salary than a part-time. And this is some of the leeway that the IRS did give us in determining what a reasonable amount is going to be, right? You can look, is this just a side gig for them? Is this just something they're doing on a seasonal basis? Maybe they do this for 15, 20 hours a week. It's not a full-time gig. Well, I think it's reasonable to say that, that should be taxed at a different rate, or they should have to take out less salary than someone where this is their main gig. They're working 40, 50, 60 hours a week. So this is definitely something that you can go and kind of carrot and look at some different ways of how to track what the income should be. And then the last rule, and I'd say this is probably the most important rule, is this is the one that is most set in stone, right? This is a very clear thing saying, don't take a lower salary than the salaries of the people that work below you. And then I have in parentheses, an owner shouldn't have a lower salary than people that report to them. And I think cognitively this makes sense, right? If you have someone who's working beneath you, you're not going to pay them most likely more than you're going to pay yourself. So this is really one rule that I would have just saved in the back of your head, where look at what their employees are making and make sure that they are making at least as much money. They should probably be making a bit more. Now, a lot of these items that we've talked about, yes, it's giving us guidelines, right? But it's not really giving us a specific dollar amount to shoot for and what the wages should be. It's just saying try to, get between these guidelines. Well, there is going to be a golden rule to reasonableness, which I have on the next slide here. And if you follow this rule, you should be A-OK with the IRS. And what this is going to be is the business owner should pay themselves what it would cost to hire someone to do their job. And you have to keep in mind, this does not mean that they have to pay themselves what someone else would pay the owner to do their job. It's just, what would you have to pay an equivalent level employee to do the job that you are doing? For example, let's say I am a tax preparer and I have over 10 years of experience. I've worked for CPA firms. I don't have to go out on the job market and see, okay, what would someone pay me to do their taxes? That's not how it's going to work. I'm the business owner. I have to go and look at what do I have to pay someone else to do the taxes that I can then go ahead and review. And the easiest way to go about finding a specific dollar amount on what they should be paid is use a job finding website to find what the average pay would be to hire someone to do the job that they would. So if I were trying to find the reasonableness for my company, I could go on somewhere like Indeed or Monster.com. And from there, I would probably pick 5, see what the average is to see what I would have to pay someone to prepare and review taxes. And I would take the average of that. And then I'd look at that average and I'd actually go back to my previous slide. Based off the average I calculated, and I'd say, okay, well, am I working full-time or part-time? This is going to be a determining factor. Am I taking a lower salary than some of the employees that work for me? And if you follow the rules on this slide with the golden rule here, you should be in a very good spot with making sure you are reporting a reasonable amount of income to the IRS. I would definitely try to keep this as low as you can. There's really no benefit in going higher than what you need to, but try to keep it as low as you can by staying in these various guidelines, and you should be following all of the IRS regulations that you need to follow. So with all this being said, I think we've done a pretty good job of explaining what income splitting is, what some of those benefits are going to be, and then the main thing that you have to be aware of is just how much wages you're going to pay the business owner. Follow these slides and we can get these slides out to you if this is something that would be beneficial. But you should be set up to at least report the income on the tax return. Now, the next item that I want to go over is how can income splitting personally benefit you, personally benefit the people that are in this presentation? And I think possibly some of you, the first benefit would be you can use this for your own tax preparation business or any other business that you run. These savings, yes, they can be used for your clients, but they can be used for you as well. If you are currently had your business or some of your businesses set up as a sole proprietor or set up as a C Corp, change it over to an S Corp. These are benefits that can hit your pocketbook directly. And I think that is a good benefit, but if you can implement income splitting as part of the services that you're offering to your clients, I actually think you can make even more money. And what I really recommend is, become knowledgeable in this. If you haven't done this for yourself, get yourself set up so you can learn the various steps and processes, which we will go over here in just a little bit of time. But if you do have once you do get that knowledge and you do feel a bit more comfortable after you've done this once, maybe twice, implement this as a financial service for your clients. And then charge them a fee to get them set up as an entity that can take advantage of income splitting. One of the benefits of offering this as a financial service is you're going to be able to look at this as better than an investment. If you make an investment into a stock, you're basically saying, I've reviewed the underlying metrics of this stock. I believe this is going to make you money, but there's a chance you could lose money. When it comes to income splitting, if this is done properly, this is going to save your clients money. It just is. And there's really low, I almost want to say no risk, but I'm going to stick with low risk. There's really not a lot of risk to your clients. And when it comes to offering this as a financial service, you're going to have a lot of leeway in what you charge them for this. If we go back to our previous example, yeah, we save that person over $5,000 year one, but they're going to save money year two, year three, year four. And I think that's really where the benefit is. For just a little bit of work, it is not complicated to get an entity set up this way. You're going to be able to save them money every single year. And that's not only going to drive loyalty from that customer to you, it's going to spread word of mouth, and it's going to really add value to the services that you're offering to your specific clients. And the next thing that I want to talk about is, let's go ahead and identify the clients that are going to get the most help from income splitting. And I alluded to this a bit earlier. Follow the money. The more money that a business is making, the more benefit they're going to get by shifting that income from sole proprietorship income into S Corp status dividend distributions. This is really going to be the first thing that I would always look at. I think this is a very logical step, and you're going to get a little bit more than just following the money as far as how much they can save. Keep in mind, we want to offer this as a service to our clients. We don't want to give this information away for free. This is huge tax savings benefits. I could know every Schedule A deduction. They can give me all of their prescriptions, all of the medical visits they had. And half the time it doesn't even affect what they're going to be paying. They're still going to be a standard deduction client, right? This is almost a guaranteed way to go ahead and actually save your clients money. And you have to keep in mind that only corporations with S Corp status can use income splitting. So I would focus on finding Schedule C clients that are sole proprietors. And there's a couple of reasons that I would focus on these clients. Reason one being, if you're set up as a Schedule C, if you're set up as a Schedule C, a sole proprietor, well, there's more benefits to being an S Corp than just income splitting. That's what the focus of this presentation today is on. However, some of those other benefits is, removing your taxable liability. If you were to get sued, for example, if you got sued as an S Corp, you can only lose what money you have in the business. Where if they're a Schedule C client, they could lose their house, they could lose their car, their 401ks could become taken away from them. There's a lot more risk to it. And what it tells me when I'm looking at my clients, if they didn't know to just go ahead and become an S Corp, well, they probably aren't very familiar with the tax law, right? And they're the types of clients that could really benefit from the knowledge that you're going to have, from the knowledge that you're going to be able to give them. So I would start with Schedule C. Now, you can make some arguments that if they're a partnership, if they're a C Corp, yes, these clients would also be eligible to switch to S Corp status. But what I think of when I hear of clients like that, they probably picked those designations for a reason. They probably did some research on the different entities that they could go ahead and set up, and they picked partnership. They picked C Corp for whatever reason it is specifically. It still may be a conversation worth having. They could have made the incorrect, or I don't want to say incorrect, but not the best taxable decision for them when they were setting it up. But if you see a Schedule C sole proprietorship, I think this is like where your light bulb should be going off. You should be saying, bingo, this is a great client that I can bring them in. And when it comes to actually going and switching over these entities to a S Corp, let's actually go ahead and talk about the steps that you're going to need to take. As it sounds very daunting when I'm talking about it, right? It sounds like this is a huge change from one entity to another. There's going to be all these steps. I'm saying you should charge your clients money to go ahead and have you do this. But when you actually look at it on the screen, I think it's going to look a lot less daunting to you. And before we get into the steps that must be taken in order to get them set up as an S Corp, let's look at the eligibility requirements, because there are some requirements that must be followed in order for them to be eligible to be an S corp. And you can see that I have a few different items on the screen here. And just to go over these different bullet points, let me read through these. Well, the first item is they must become a domestic corporation incorporated in the United States of America. Second item, shareholders must be individuals. They could also be certain trust and estates, but in my experience, I don't run into a lot of that where people are getting themselves paid through a trust or getting themselves paid through an estate. It certainly happens. I don't want to say this is like something you'll never run into, but most people that own a business, especially Schedule C sole proprietors, most of them are already paying themselves as an individual. Third item is they must have no more than 100 shareholders. I have never personally done a tax return for a company that's had more than 100 shareholders, and I did work for one rather large CPA firm back in my time in Washington, D.C. I don't foresee this being a big hurdle where they're having over 100 shareholders that are taking money from this business. And then lastly, they must have only one class of stock. And my question to you all in the audience is based off this different criteria. How many of your clients would not qualify for S Corp status? Would all of them qualify? Would 95% qualify? You know, I would guess, and I can only guess since I don't know the specifics of your business, but I would guess that almost all to maybe even all of them would be eligible for S Corporation. And one of the things that I did is you can see some highlights that I did for the 4 bullet points. And when it comes to items 1 and 4, I had this highlighted in blue. And the reason I highlighted it in blue is when you actually get them set up, let's say you're going to move forward and get them set up as an S Corp, this is something that you get to pick. You get to pick where they're incorporated at. You get to pick what types of stock they have. This should really never be a reason, unless they're a foreign client and they do want to be incorporated, you know, in their native nation. You know, that might be a limitation, but you know, the vast majority of U.S. income taxes is done by U.S. citizens. So these items will be in your control. When it comes to items 2 and 3, you can see I have individuals and 100 highlighted in red. And the reason I highlighted these is most, if not all, of your businesses that you're doing taxes for, they're going to be paying themselves already as an individual. And it's going to be very unlikely that their company would have over 100 shareholders. Most of them would probably just have one. So I don't foresee any of these being huge limitations. If it is something that you occasionally run into, you know, I feel like it's going to feel more like an one-off situation where, oh, I thought this person would be eligible, that they're not. But the vast majority of your clients should be eligible based off these different criteria that the IRS has gone and given us. Now, when it comes to the actual steps to going ahead and getting these clients set up, let's go ahead and talk about these different steps. And I have gone ahead and, you know, I'm located in the state of Florida, so I'm very familiar with the state of Florida steps to getting this done. I do have to kind of throw a disclaimer out there, as I know that this is a nationwide broadcast. The steps might vary a little bit from state to state. As when it comes to incorporating businesses, that is a state issue. That is not an IRS issue. That is not federally mandated. And you will see that there are a few differences as you go from state to state. But generally, the core is going to be the same. And you can see I have this listed as a 2-step process. We will drill down into a little bit greater detail into these 2 steps. But really, the 2 steps you have to know is step 1 is you have to file to have their existing business set up as a C corporation. I know I keep saying the word S Corp. We're going to have to get them there. But the first step is going to be get them to set up as a C corporation. Once they are established as a C Corp, you're going to file Form 2553 to go ahead and change them into an S Corp. And the reason that these steps are listed in this manner is before any corporation can become an S Corp, they have to be approved by the state to be a C Corp. So that's why you have to take really, I don't want to say an unnecessary step, but an extra step in the process, where you're going to have to go from sole proprietor to C Corp, from C Corp to S Corp. And what I can say is that this process But it might sound like it's going to take a ton of time to switch from one entity to another. I promise you it does not. It takes at most a couple hours. And to really drill down into these specific steps, I've gone and highlighted these in blue, and then we have our normal black font. And the reason that I've gone ahead and highlighted these specific items is really you're going to get this done in 2 batches. Batch 1 is going to be changing them from whatever they are, probably a sole proprietorship, into a C corporation. That'll be your first step. That's all going to be in blue. Item number 2 is going to be taking that C corp and changing it to an S corporation. That's going to be in black. You will do these steps at the same time, meaning all of the blue bulletin points you see, that'll all be done at the same time. And everything that you see in black, that will be the second step, that which will be done at a later date. And just to go over the specific items here, let's go ahead and read through these, and I'm going to go ahead and add some commentary to what each one of these mean. Well, when we are going and switching from a sole proprietor or a different entity to a C corporation, keep in mind these are the blue items, we're going to have to create the articles of organization. We're going to have to do a few things. We're going to have to go ahead and describe the business hierarchy. Who are the owners going to be? Mostly there's only a single owner, but it's not uncommon for them there to be more than one. We're going to have to explain the structure. And the reason that we have to explain the structure of who does what is the IRS, really the states want to know this in case there's ever an issue where they need to reach out to the business owners, the CEO, CFO, whatever the situation may be. This is going to have to be listed in black and white, so the states have at least some sort of go-to place if they do need to reach out to the company. Step 2 is going to be create an operating agreement. You're going to describe who's running the company and what stock will be used. I would not get too hung up on the stock types. They're on the forms that you have to use to go ahead and get them set up as a C Corp. You're just going to go ahead and select one stock option. Just make sure you don't select one that is going to be one of the requirements to getting it to an S Corp. Is they can only have one class of stock. They can't have, voting, non-voting, operating, non-operating. So don't even really worry about that too much. Just go ahead and just pick, just the standard stock and just only have that one option. You may have to file for an EIN, the employee identification number. I know in Florida, this is a step that you have to take while doing my research for this presentation. I did see there are a few states where you can use your social security number. You actually don't have to file for an EIN. Really a quick Google search should be able to tell you this. Just Google your state. Do I need an EIN to become a C Corp? And that's going to let you know if you have to fill out that specific form. And then lastly, we have files to be incorporated as a C Corp, not as an S Corp yet. Just make sure, really, I guess functionally from your end, this doesn't really need to be listed as we're filing for C corporation status. I just wanted to make it clear with this bulletin point, that we're not filing to be an S Corp yet. This is going to be the second step, is taking this to an S Corp. And long time ago, I used to own a business, and I actually did get myself set up as S Corp. And I would say once I filed as a C Corp, I think it was like between 4 to 6 weeks for me to get that official designation back from the state, just confirming that I am a C corporation now, and that if I would like to switch over to an S Corp, now would be the time to do so. And really the step to switch to an S Corp is even less time intensive than switching to a C Corp. You can see I have form 2553 on the left-hand side of the screen, at least a snippet of that form. And all you have to do is file this form 2553 with your state to get you switched over to S Corp status. And this form is a 2-page form. It's a 2-page form, and furthermore, when I got the C corporation articles back from the state, they actually sent me this form to me with most of it filled out already, and they highlighted the specific boxes that I needed to tick off, I needed to check, that I needed to sign in order to resubmit it back to them. It was very easy. The state was actually very, very helpful in getting this information signed. And I believe I just signed my name and my initials in like 2 or 3 places. I just said I wanted to become an S Corp by checking a box. I picked my fiscal calendar year, and that was it. I was done. It took probably 5 minutes for me to go ahead and fill out. I would say when it comes to the blue steps, actually becoming a C Corp, this was a little bit more time intensive. This probably took me about 2 hours. But start to finish, when just looking at hours worked on switching the entity and then switching to S Corp, it probably took me under 3 hours total. And the process probably took about 6 weeks because I had to wait to hear back on my C Corp status. But as far as like work put into this, not very time intensive at all. It was very, very simple. It was very easy. I was actually surprised at how easy it was. Now, I do have one more bulletin point on this slide that I do want to go ahead and caveat. If they are already existing business, meaning this is a business that you are switching over, this is not a new business, they have to file for S Corp status within the first 75 days of their tax year. And bear with me for 1 second. Okay, I had a note saying that I have a connection issue. Amar, can you all hear me all right? Okay, so I'm going to go ahead and continue here. Please bear with me. Let me go back to the slide we were on. Apologize for that. So,
We can hear you. Sorry.
like I was saying,
we can hear you fine.
Okay, great. Okay, I had a message saying that my connection was bad, but it looks like I'm still on the internet. You all can hear me, so I'm going to go ahead and proceed. So last little thing to caveat is that if it's an existing business, they have to do it within 75 days of their tax year starting. This does not necessarily mean of January 1st of the calendar year. It's just whatever tax year is selected on the form 2553. You can see the section right here. Whatever their tax year is, they have to go ahead and start this within 75 days. So I want to give you all a couple more items to consider when it comes to income splitting. I'm then going to open this up to a few questions, and then if we have time, we're actually going to go into a tax prep software to look at this. But before we do all that, let's talk about the additional items to consider. I would say the main item to additionally consider is that you only have 75 days to start from the start of that tax business year, and you kind of need to keep a track of when their business years are going to start. And the reason for this is if they have a January start to their tax year, well, you're looking at getting that done by March 15th. You're going to be really busy by March 15th, right? Those may be clients that if you are going to offer this service, that you need to go ahead and maybe wait till next year. But if you do have clients that are a mid-year start, start identifying them now. The more clients that you can identify now for this service and have that conversation, you can kind of get the ball rolling, get those forms ready to file when it's the appropriate time for them. If you wait until busy season, most likely if you're like me, you're going to be completely overwhelmed. And the last thing you're going to be thinking about is income splitting and switching entities when you're already trying to get a tax return done for the current entity. But it can be good during busy season to go ahead and get that list together. And right now we're only midway through November, so we still have about 2.5 months before it gets really, really busy. Start identifying these clients now that you think you have a good relationship with that would be open to getting their entity changed and to lowering their taxes in the very near future. Start identifying them now, as that'll pay dividends for your company down the road. Another little tiny benefit that you will get, and I don't want this to make it sound like this is going to be the main benefit, but you will get to do 2 tax returns for your client. If they are a Schedule C client, they're now going to be an S Corp. They will have to go and file the 1120S, and you can go and do those tax returns for them. This should be a small bump in revenue for you. I don't think this is where the main savings is really going to come in, or the main revenue generating activity, but this is a small benefit on your end. And then the last thing that I'm going to go ahead and impart onto you all is I would be aggressive in your pricing. Income splitting is not an investment that may lower your client's taxes. If this is done properly, this is going to lower their taxes. And while we may now know that the time it takes to do this is not a lot of time, it's only a few hours of work, at most a day of work. Really your clients are paying you for their knowledge, and this is going to save them money year after year after year. I would be very aggressive with your pricing, as there's really not a lot of risk that you're going to go and impart to your clients. If anything, you're going to shield them from a lot of risk, from liability as well. So whatever you think you can get away with, I think it's a fair price for them to pay for this service, as it's going to be a one-time fee on your end to get them set up. You may get a little bit bump in revenue by doing 2 tax returns for them, but ultimately, this is really going to benefit your clients. And as the more of these you do, I think the more you will feel that this is really a nice little tool that is not a lot of work for a lot of benefit. So this is going to take me through the end of my actual presentation portion of our webinar here today. But I do want to ask you all a quick polling question. And I just want to see, based off what I've told you today, do you plan on adding this as a financial service that your business can go ahead and take advantage of? And the reason that I'm asking this is, this is a more complex topic than we've done on one of these tax schools before. Typically, we're looking at specific forms within a 1040, right? We're looking at the Schedule C, we're looking at the Schedule E, maybe the Schedule A, for example, or maybe just doing a basic overview of the entire 1040. This is the first one of these that we've done where we're kind of talking about a more abstract issue, an issue outside of tax returns that can generate money for your company. And I just want to see if this was something that was beneficial to you all. If a bunch of you think that you're going to use this as a tool, I would like to do more of these that are kind of in this format. But if this just seems like something that the majority of you don't have a lot of interest in after the presentation, that's very good feedback for me, just so I can set these up and make sure that we're giving you content that's really applicable to your business. So don't feel like you're going to hurt my feelings. This is really just to make sure that we are providing the best content for you as possible. So I'm going to go ahead and give you all a little bit of time. Let's go ahead and go through the results. And from there, let's see if we have a few questions. We'll go ahead and answer those. And if we have time, we'll go into the tax software. And if we could get those results just when you think it's appropriate and most of the people have answered, that would be great.
Sure. I'll go ahead and close it. Looks like half the people said yes, half the people said not sure.
Not sure. Okay. And so what I'd recommend for those not sures, probably this is still a little overwhelming. This is a very big topic. I only have a limited amount of time. There's some great articles out there that you can find that can really break this down in a little bit greater detail that I can go through in one of these. And regardless, either way, I do hope that some of you find advantages and can really implement this as an additional way to generate revenue, especially during some of those slower months where we're not pulling our hair out trying to get so many tax returns done. Before I jump into the tax software, do we have any questions in the questions tab?
We do not. There are no questions.
So not a problem. What I'm going to go ahead and do then is I'm actually going to go ahead and jump out of PowerPoint. And I want to go ahead and log into TaxWise Online. And I do want to talk about just some of the differences when it comes to actually reporting the income taxes on the 1040. So when we log into TaxWise, let me go to my return manager where all my returns will be stored. And let's go. Looks like I have a very basic return that I started. I don't even think there's any financial information that we are currently doing, but are using. But I did put in some of the basic information on the main information worksheet. And let's actually go ahead and input a Schedule C, just so we can kind of see what we're doing and how it's going to be reported differently. When we input the Schedule C, you can see there's a few boxes here underlined that we need to check. I'm going to skip over these just for the purposes of going through these different items. But when it comes to inputting the revenue for the specific company or the expenses, the majority of this work is getting done on the Schedule C, which is obviously part of our 1040. So, as we go ahead and put in sales, we'll put in revenue, profit, etc., these amounts will be changing what's reported on the 1040. We could input advertising expenses, really it doesn't matter. Whatever the situation is, whatever their expenses that they give us, we're really just recording it on this schedule. And as these numbers flow through, it automatically is going to flow through into what is their AGI, what is their taxable income due, what is their refund if they have a refund amount. This is how you do it when they're a sole proprietor, right? This is the form, the schedule that we use. And we're probably all pretty comfortable with it. I know this is one of the more common items within a 1040. Now, if we were to switch them to an S corporation status, keep in mind we now have to do 2 tax returns. We have to do an 1120S tax return, and we have to do a 1040 tax return. And what you really need to know about getting the figures for their 1040 is the majority of that work is actually going to be done on the 1120S. When we're filling out the K1 info and what income is going to flow through into the 1040 for a particular client, well, that's going to be done on the 1120S side. When we actually have the K1, we actually have the information available to us, we would just go into our tax software, and we're just going to go ahead and add in a K1. Let me go ahead and make sure that it didn't already add one right here. Let me go back, K1, there we go. And it's going to be a partnership or S Corp K1 worksheet right here. And what is going to happen when we switch from a sole proprietor to the S Corp is we are no longer going to need the Schedule C. This is going to be a schedule that we're going to no longer need to prepare for this entity. Reason being is that this is being done on the 1120S form, all the revenue, all the expenses, etc. What will be generated when you are done with the 1120S and you're done with the K1 is the K1 for your specific client. You are going to add in a K1 worksheet, which we can see here, as opposed to the Schedule C. You could really just remove the Schedule C at this point. And the K1 info, it's really just matching it and typing in the information into the correct boxes. Really, when it comes to inputting K1 info on the 1040, you're not really doing calculations. You're not really playing around with the numbers anymore or thinking about what those wages are going to be. It's just finding the box on the K1 and then inputting it to the specific fields within your tax preparation software. And one of the nice things with the tax preparation software like TaxWise is that if this is something new to you, if this is something that you haven't done too many of, maybe you haven't done any of, there is a very nice feature within TaxWise called Get the Red Out. And if you've seen one of my presentations before, I almost bring this up in every single presentation I do, but I think it is that important of a feature where anything that has to be done in order for this return to be accepted when you go ahead and e-file it, any of the critical bits of information that are required by the IRS, there's going to be a red underline under these specific fields saying this is a field that has to be done. If you do not do this field, this return is going to get rejected by the IRS. And while you're looking at a worksheet like the K1 worksheet, you can see there's not a ton of red underlines, as there's not a ton of critical information. The K1 could vary greatly on a case-by-case basis. But what TaxWise is going to go ahead and do for you is that if we actually look at the left-hand side here, we can see that on our tree of all the different forms, schedules, worksheets that we've brought into this tax return, we can see that some of these have a green check mark, some of these are in gray, some of these have a red exclamation point. Well, these are going to be a color-coded system that is going to give you a lot of critical information about what needs to be done on this tax return. Just to go through this different color coding, anywhere where you see a green check mark, this is going to mean all of those red underlines that are must be done in order to get this return accepted by the IRS. That's going to mean that they are complete, that there are no more critical items that have to be done. Anywhere where you see a gray item within your tree, this is going to just let you know that there are no critical items that need to be completed, but you also haven't input any data. This is actually going to be a blank worksheet that we've brought in, and we have not yet begun to type in the financial information. And anywhere where we see red, the red exclamation point, that is going to let us know that this is an area or a form or a schedule where there still is critical information. We are missing critical information that must be done. And if we actually go and click on Schedule 1, Page 1, you can see that it's actually going to highlight these bits of information. And you can see we have items like the yes, no, very basic, but as we continue to scroll down, looks like just the yes, no. But as I click yes, you can see more items becoming underlined. That's because this is a variable system, it's interactive. As you select certain options, other options may become items that have to be done. And as you start to input these different amounts, you may get more red underlines, but if you don't, look, you can see on our tree, Schedule 1, Page 1, this is now an item that has been completed. There are no more critical bits of information that must be done. One thing to make note of, though, and one thing to caution, is it's still going to be up to you to input the information correctly. There is no way for the tax software to go ahead and actually, verify that the information is correct as far as how it's typed, but it is going to do that double check to make sure that you are not missing any critical bits of info. And there is going to be one more tool within the system called the diagnostic report, which is really going to summarize, these red items here in a very concise manner where you can see specifically, okay, what are these red items that are within the return? And you can just click on these different links to go ahead and bring you to the exact page you need to go to clear up these red items. With all that being said, it looks like we're just bumping up against time. So if there are no further questions, I'm going to go ahead and open this up to our last polling question, and just give me 1 second to go ahead and drag this over to the screen. Let me go and find my PowerPoint. Here we are. Let me go ahead and switch this over. We will go ahead and swap. And I do want to ask you all, would you like a more in-depth product demo and further details about TaxWise Online? Based off everything that we've gone over here today, we do offer a very comprehensive tax software that can get all of the items that we've talked about done for you. And we just want to see if this is something that you want to learn more about. And if you do, great, say yes. If not, say no. Or if you're already a TaxWise user, just let us know. We like to track the internal numbers to kind of see who's been using this and coming back to just learn more about these presentations and who's actually out there looking to possibly upgrade their tax software.
Give you a little more time.
Sure, yeah.
Looks like mostly everyone voted.
Okay, fantastic. Well, I would like to thank everybody for taking a little bit of time out of your day in order to learn about income splitting. Would also like to say that busy season is right around the corner. I know how stressful it can be. I've done quite a few. I want to wish you all the best of luck through getting through a smooth, busy season. And additionally, I hope it is a very, very lucrative time for you. Is there anything else that you'd like to add, Amar, before we go ahead and shut down this presentation today?
Thank you, Ryan, for another wonderful presentation. Stay tuned for more. We'll be promoting our next one soon. So if you found this interesting, please be sure to join us in the future, as we'd love to have you. And please feel free to reach out to us if you have any questions about today's presentations or if you're interested in learning more about TaxWise. And thank you for joining.
Thank you, everybody.